So moving on to our second risk, credit risk. This is obviously a big one. This is one we're talking about a lot with coronavirus. Firms like JCPenney, Sears, Bed Bath & Beyond, a lot of restaurants, especially smaller restaurants, cruise lines, airlines, even banks, because they're loaning out money to these entities. There's a lot of risk right now with credit, people going bankrupt. The energy industry, with oil prices so low, there are some firms that are toppling. We've seen some stock valuations drop 80, 90% in some energy companies just because oil prices are so low, and some of these firms just are not going to be able to survive, people doubt, without the government stepping in. We'll be curious if the government can get this right. There's a big issue that I think I should bring up here because I think it's really, really important, and that's the issue of solvency versus liquidity. We talked about solvency and liquidity on paper one. So solvency is you're bankrupt. The business has failed. There's nothing else there. You're just going to go out of business. Liquidity is you need cash now, but long term you are okay. And so what the federal government has to figure out, this is a big issue in 2008 with firms like General Motors and AIG and Lehman Brothers and Morgan Stanley and Merrill Lynch, is asking the question, are they insolvent? Is the business just bad, about to go under? Or do they just need some liquidity help? And the government says, well, we don't want to step in and bail out an insolvent business because we'll give them a lot of taxpayer money, but they're going to go under anyway, and we're just making the problem much worse. We're going to waste a lot of taxpayer money, and then ultimately the failure is going to be even worse. But we do want to help out these companies, and that's essentially what the federal government's trying to do right now with the COVID-19 bills, is let's find those industries like airlines, like cruise lines, that, well, they're legitimate businesses, but their revenues have dropped 80, 90% overnight, which we've never seen anything like that before. It's amazing to me the number of record numbers we're seeing, whether it's jobless claims, and we're probably going to see something with unemployment. I was looking at capacity utilization, and this last month it had its biggest drop ever. Capacity utilization is how much of our resources are we using between people and buildings, and we're grossly underutilized, which is good news for inflation, but it's bad news for economic growth. The retail sales came out today and had the biggest drop ever in retail sales, so consumers aren't spending. So if this is a temporary problem, then can the government step in and provide liquidity? Now, I know some firms that probably are bankrupt. I've been working with them, and just their business model doesn't make sense, and some of them are applying for these small business loans, but the government will let them stay in business as long as they keep paying their employees, and the government will actually reimburse them some of those employee costs. It bothers me. Some of those entities really should be out of business. Their business model is terrible, and now they're going out of business because of this recent legislation. They'll probably survive an extra 4 or 5 months. As soon as COVID-19 is over, they'll probably go out of business then. So we're going to throw some tax dollars at them, and it's going to just be wasted. So it's an important question. It's very hard for governments to get this right and for the Federal Reserve to get this right. But when do you provide support? You want to provide support when there's a temporary liquidity need. You provide that liquidity, they survive the crisis, they come out on the other side and they're fine. You don't want to supply support for firms that are actually bankrupt. Japan is a good example of this. Japan has some banks that probably should have gone insolvent, but the Japanese government propped them up, and they've just been these comatose banks for years and years and years. Their economy would probably have been better off if they let these banks go under. But if they'd gone under, they would have laid off a lot of people, and it would have made the crisis worse at the time. But here, 10, 15, 20 years later, they would be a lot better off. That's somewhat of the question our Congress has to decide is do we want to let the crisis be bigger now, but then have some really bad companies go out of business and some new, better run companies will take their place, but then a lot of people get laid off? Or do we try to prop them up and we'll just have to deal with, kick the can down the road? Most governments, kicking the can down the road is the best solution. So that's where we're getting to here with credit risk. Credit risk is the risk that someone who owes you cash and they fail to perform. The contract says they're supposed to be sending you $1,000. It could be someone who's renting property from you. It could be a bank who has an auto loan, or it could be a bank with a mortgage, or it could be a company that has borrowed money, and they can't make the next payment, and they're in default, or they have risk of default. So it's bankruptcy of someone who owes you money. How is it measured? Well, you saw this on paper 1. Remember, we used credit ratings, and we also used the Bloomberg default probability. I do provide some historical information. I can't remember if I put it out there on Blackboard yet. I'll try to remember to make sure I have that out there. But there's, if you go out to Google and do Moody's default study, I don't know if 2018 is available, but they do provide their default studies for free. Now, sometimes you have to register. I think S&P has stopped supplying them, but they provide some really good information online for free. I have one of the default studies, actually as a PDF file, and they're interesting. Even if they're a couple of years old, the information in them is amazing. See, I have to log in here, so it's getting tougher. They're getting a little more private with the information that they provide. So here's one. This one actually works. So this is it's really old, 1920 through 2010, but just incredible amounts of information all the way throughout. It won't load very well because I have Camtasia open to make this recording. But if you are a finance major and you want to interview with a bank, especially investment bank, or especially if you go into commercial lending, you want to read this report. Now, it looks really lengthy because it's 66 pages, but probably 2/3 of that is graphs. So it's not nearly in graphs, and probably even more than that, graphs and tables. Incredibly good read. I would definitely want to read this before you interview with, like if you're interviewing with Frost Bank or Morgan Stanley or Goldman, this would be a very good thing to read. You can see how many tables they had, and a lot of these tables you'll just flip through because you'll see what the table's measuring and maybe look at a couple of things. But see, the majority of this is just transition matrices, very interesting stuff. So it's probably, what did I say? Probably it's 80% tables, 90% tables, and very little. So there's not much to read. So yeah, you just type in. So this is Moody's corporate default and recovery rates 1920 through 2010, and it's fine. I know we've had a crisis here recently, but the 2010 has the 2008 crisis in there. And not much has happened between 2011 and 2019. A lot has happened this year, but still it's not going to be reflected in the default recovery rates because even though a lot of firms on the edge of default, not many of them have defaulted yet. So you haven't seen those numbers yet, but that's what we're looking at. So that's what I mean here about look at that. So there's two things you're looking at: the probability of default, that's frequency, and how much you get back if they default. So that's kind of the opposite of severity. Severity is how much you don't get back at default. So if a single A firm maybe has a 1% chance of going into default in the next 10 years, and if they default, you'll probably get 50% or 40% of your money back. So you have a 1% chance of them defaulting, and if they default, you'll lose 60%, but you get 40% back. That tells you how much extra return that bond needs to pay you. You need to cover the 1% chance of default and take 1 minus the recovery. Recovery is 40%, then you're going to lose 60% and 1% of the time. So 1% times 60% is 0.6%. So you want to add that 0.6%. So remember when we were doing WACC, the weighted average cost of capital, and you went to that table and you brought in the spread. If the spread was 60 basis points, that's 0.6%, then that would cover you for a 1% default with a 40% recovery. How do you mitigate credit risk? Well, you have risk limits, concentration limits. You make sure you don't have more than a certain amount of money in one industry or in one company. You have aggregate limits across entities. You have covenants. And we do have insurance, something called credit default swaps. Very confusing things. I've never bought or sold a credit default swap. I find them very, very interesting. I would love to deal in that security, but I don't have that background. I've done a lot of interest rate swaps, but I have not done credit default swaps. So it's an interesting asset. So you mitigate it just by making sure you spread the risk. That's what we did at USAA. My responsibility at USAA was to set up these limits. And so I set them up based on the credit rating of the firm. So firms with high ratings, we could have more money invested in them than firms with low ratings. I took that to the CEO, and he says, no, your limits are too big. You need to bring them back. He said, work on it some more. I finally just said, there's nothing more I can do. You just got to tell me what you're comfortable with. And he put some really restricted limits on our firm. The portfolio managers were livid with me. They were mad at me. They were mad at me even though they knew it's the CEO that made the decision, but they had to be mad at someone, and they didn't want to burn bridges and be mad at him. And before he did that, before he made that change, there was a company named Enron that was one of our largest exposures. And when he instituted these new risk limits that were much, much lower, Enron went from like maybe $200 million exposure down to like $40 million exposure. And then Enron went insolvent, and all those bond portfolio managers, they went from calling me stupid to calling the CEO smart. So when they didn't like it, they picked on me. When they liked it, they complimented the CEO. So I couldn't win no matter what I did. But it's tough to know what exposure do you want. Do you want 10% of your money in one company? Procter & Gamble, Microsoft, these are really safe companies. Having 10% of your money, you'll probably be okay in there, but you never know what's going to happen. The world could change dramatically, just like we've seen here recently. So maybe you don't want 10% of your money in one company and the bonds in one company. So those are decisions you have to make. So that's credit risk. It's an important risk. And then the last one is a catch-all risk, operational risk, and that's everything else. Some procedures, some policies, some employees, someone does something that causes you huge risk. This is really an internal control thing. I talk about earlier, we talked about rogue traders, and we talked about Barings Bank and how that was an internal control, an audit issue. Theft is an issue. An override system failure, you don't have good controls in play. You got to test them. What's your backup plan? So we've seen flash crashes where markets will drop, a large amount of money just because some trading system had a mistake in it. Societal Generale, one employee was just mad at the firm, so he decided to lose them $100 and something million, just purely out of spite. He didn't make any money off of it. We've already talked about these. Exxon Valdez, I don't know if y'all probably don't remember that. It was before your time, but an intoxicated tanker driver caused a major oil spill in Alaska in this this pristine environment. Oh, it was just horrible for Exxon. We saw the same thing with British Petroleum a few years later. 9/11, that was an operational issue where airlines were not locking the cabin door. So you say, well, let's start locking cabin doors, and then a few years later, one of the pilots goes to the restroom and the other pilot locks the cabin door, and then he intentionally crashes the plane. So you think through the scenario, you think you've got a new scenario that's going to protect you, and then something like that happens, which is just, incredible, unpredictable type of things. Your hiring practices, what your human resources policies are, that's important. Reputational risk. We're seeing this in the Me Too movement, where we've seen some major players. Charlie Rose, to me, was the most shocking. Just some of the things that he was doing to the female interns at his firm. It just is shocking that someone could be that unethical and just that ridiculous. But it caused huge issue. Ended his career, but also horrible headline risk for his particular news firm. I forget whom he worked for, but one of the major networks. The lawsuits, those are huge. A firm can be sued for billions of dollars. We talked about that in my property and casualty class. Then you just have operational disasters. British Petroleum, just mentioned them. They had an oil crisis in 2010. I found an article on British Petroleum, and so I took some quotes from it. Talked about the lessons that they learned. They said it was a perfect storm. They had aging infrastructure. They were overzealous, cost cutting. They really weren't thinking about risk. They were concentrated. on form, not the substance of regulation, just going through the motions. They ignore warning signs, kind of close calls that happened that they should have paid attention to. You can see all these quotes, and this says, well, wow, they looks like they learned a lesson. The only problem with it is that the article I was reading wasn't about the April 2010 oil accident. It was an article that they wrote about all the losses they had had going up to November 2006. So I had all these quotes about how they finally learned their lesson. Now they're going to do risk management well. That was written in 2006. In 2010, they had a loss that really cost them billions and billions and billions of dollars. But they've survived it. Really, that wasn't that much money given how large the firm is. And a lot of people can only address risk in the middle of a crisis. As Warren Buffett says, you'll know who's not wearing a swimsuit when the tide goes back out. It's at times like this that risk management matters. A lot of firms is like, hey, we've made it 10 years, 2009 through 2019, 10 years, no problems, where those were really fairly easy years. We had the Tokyo earthquake. We had a little bit of blow up at the end of 2018, but nothing all that serious. And firms are like, what are we worried about? Everything's working fine. Well, you don't learn about how good your risk management is in normal times. You learn about it in a COVID-19 crisis. You learn about it in a 2008 crisis. So, oil companies right now, they're learning about it, seeing oil prices drop 50% in just a matter of days. Just incredible things that are happening in this world. Restaurants finding out that their revenues are dropping 90%. Some restaurants are making it out. There's a Bill Miller that I ride my bike next to, and boy, they're doing great. Their take-home orders are they have 20, 30 cars sitting in line every single time I go by. But then I go by the Taco Bell. They're still selling, at the window, but there's almost no one there. They must have laid off a lot of workers. So, those kind of things, they can happen overnight, things just out of the blue. No one was thinking about this at all in December 2019, and here we are in a major crisis. You'll find out if your firm is ready for risk management when the crisis hits, and that's a little too late to find that out. How do you measure this? I don't know any way to do it other than, you go through scenarios. You can't actually ask, what is our value at risk of our operational risk? I don't know how that you do that. There's a firm called SAS, and I told them how do we measure operational risk? And they said, no problem, we have a model to do that. So I went to the meeting, they said, we just need all your inputs for risk, correlation, expected returns. We'll plug that into our model and we'll give you a number. And I said, but I don't know what those numbers are. I don't know what the correlation of headline risk and hiring risk is. Or some rogue trader or some employee that does something, I don't know what those correlations are. I don't know what they're related to. I don't know if they're related to the stock market or interest rates. So I thought it was essentially a pretty ridiculous meeting, and they somewhat got my point. I hope I didn't hurt their feelings. You can look at close calls. This is something I do in my own personal life. I ride bikes every day, and bike riding can be really dangerous. But I'm always paying attention. If I have a close call, I think about what that was, if it had to do with the road I was on. I have recently radically changed my route because there was a road. I just started thinking there was cars just passing by me way too closely. So I radically changed the route so I could avoid all that traffic. And so I feel much, much safer now. And even then, there's a part of the route I'm doing that's a little dangerous. And so I will actually get off the road and ride in the grass just to avoid any of those. So those close calls, I think, can be really, really useful. You'll see a lot of times close calls are completely ignored by management because nothing happened, and then the next time it happens, it's horrible, and they wish they'd done something about it. So British Petroleum, Exxon, having an almost oil spill, should have gotten their attention. They should have done something. How do you mitigate it? Great procedures. Procedures can be unwieldy. When I started at the investment company, when I was head of equities, my compliance officer came in and she handed me 2 notebooks that must have each been 5 inches thick or more. She says, here's your procedures. And I was like, there's no way I'm reading all of these procedures. I says, just you tell me what I need, what I'm responsible for doing. Make sure I don't get myself in trouble. She was very good at telling me when we were close on something and to watch out for it. But yeah, it's constantly think about what can go wrong. How could you destroy your company? And then just make sure that can't happen. One person shouldn't be able to destroy a company. UTSA gave me so much power when they let me do swaps and options, and they put no constraints on me whatsoever. I had to go in and set up my own procedures to restrain myself. Just in case I'm having a bad day, come in, do something stupid. I wanted someone there to say, why, you can't do that trade, that's not allowed. But when they first set me up, they were letting me do billions and billions and billions of dollars in trades with no restrictions whatsoever. It just made no sense to me. They just like, well, we trust Ron. Well, they shouldn't do that. When measuring performance, focus on process more than the actual outcomes, because it's very hard to tell between skill and luck in finance. Sometimes a firm's doing well just purely because of luck. And some people say, well, that's because we're doing really well, when it's just pure luck. You need to look at the process and see what's going on in the process, and when this luck runs out, what is it going to look like? And my main thing I will tell you, and this is, boy, I repeat this all the time in risk management class, go to the extremes. Run scenarios like you're an oil company, run a scenario where oil prices drop 60, 70%. And take those scenarios to top management and say, hey, if interest rates jump up to 7%, this is what's going to happen. If inflation jumps to 4%, this is what's going to happen. If the stock market falls 60%, this is what's going to happen. And do it as a regular part of your business. That's what we did at UTSA. We met quarterly with the CEO, and we ran scenarios that were extreme scenarios for interest rates, the stock market, just so he could see what would happen. If he didn't like those numbers, we would reduce the risk, just like you saw with value at risk. We would reduce the risk so that we wouldn't have the extreme losses he wasn't comfortable with. So your risk controls are important. We talked about avoidance, prevention, and reduction. But you gotta be careful about the interactions. Sometimes risk prevention can increase severity. There was a story of a city that closed a bridge down because it was wobbly, and they only had 2 bridges, and so all the traffic shifted to the other bridge, and then that bridge collapsed because it held all this extra weight. So you're trying to focus on one thing, you actually create a risk somewhere else. So a lot there. Some of you are accounting majors, you might get involved in internal controls and policies and audits. That's not the most exciting part of the world, I don't think, but you can add a tremendous amount of value. There are people who love that and they're very good at it. It is definitely going to add a lot of value if you do your job, if you're paying attention. All right, so that's it for risk management. So next few sessions will probably be the end of the class. We're going to do asset valuations. We'll do bonds first and then stocks. So I actually like this. I think y'all will find this a pretty fun part of the class.